Hello and welcome to the Art of Commercial Mortgages for Residential Mortgage Brokers. I'm Joe Marticich. I'm excited to share this with you. This webinar that you're going to be watching is actually a compilation of a couple of different webinars I've done in the past. I've edited those parts together, so I wanted to put this new introduction and explain that to you, and to give you a little bit of a further introduction as well. So you're going to learn a lot about how to look at commercial deals. You're going to see how this business integrates very, very well with the residential business. And you'll see a whole bunch of examples of transactions, photos of the properties, details about those deals. So I hope this is going to be extremely valuable to you, and it's going to be inspiring so you can see that you can do this. Every one of the deals that you're going to look at in this webinar were deals that were sent to me by a residential mortgage broker. Well, I think maybe one of them was a pure commercial broker out of all those deals, but most of these have come from residential brokers. So I hope that's inspiring to you, so you can see that people are making money doing these deals that don't have any background in commercial. And my best piece of advice to you, I've been in conversations with many residential LOs that want to get going in the business. They want to know what they can do. Number one, the most important single thing is just let everybody know unequivocally that you do commercial mortgage loans. When you're asked about something, a potential transaction, don't say, yeah, I kind of sort of do it. I'm starting to do it. I'm thinking about getting involved. No, what you want to say with absolute confidence is, yes, I do commercial. I can help you. And you want to let all of your sphere of influence know that you're now doing commercial as well as residential. Your real estate brokers, all your other referral sources, all of your clientele. Just doing that alone will lead you to a whole bunch of transactions. I've seen it time and time again. It'll happen for you too. The second thing is that just jump in. We can talk about this. We can teach about this. You can read a lot or study a lot about commercial. But the best way to learn to do commercial is by just doing commercial. Jump in and do your first deal, 2, 3. Don't hesitate. Don't let fear get in your way. Don't let pride get in your way, because this is something that's relatively new to you. Think back to when you started in the residential mortgage business and you did your first couple of transactions. You didn't know everything that you needed to do perfectly. You didn't know all that was coming in that transaction. But you jumped in, you did it, and you were successful. And by doing a few of those, you became better. A few more, you became even better, and now you're an absolute stone cold professional at the residential business. Well, commercial works the same way. The only way to learn how to swim is to get in the water. Now, I can provide you a whole bunch of information. I've got more educational stuff that I can give you, but my best advice is just jump in. Start at the very least, with letting everybody that you know that you do commercial, and when you get requests, answer with absolute confidence, yes, I do commercial. If you do want to take this to the next level, if you want to market and get a whole bunch of commercial and build a large commercial income, then I've got some ways that I can help you with that. And really, the best thing to do is give me a call, and I'll find out about your specific situation. And based on that, your business situation, I can give you some advice as far as the best ways to get going in that regard. So my contact information is going to be at the end of this webinar, but for right now, I'll give it to you anyway. My email address is joemarticich@gmail.com. It's just my name, as you see on the screen, but with no spaces, joemarticich@gmail.com. My direct number is 801-822-6301. And if you want to talk about how to build a large commercial practice, I'm here to help you do that. So anyway, without any further ado, I hope you enjoy the Art of Commercial Mortgages for Residential Mortgage Brokers. So just a quick minute, I'd like to give you a little background about how I started in commercial, because I think especially for those of you who are either residential or both, and we didn't have anybody respond to the poll saying they're commercial only. So everybody is probably residentially oriented, and maybe a few of you do a little bit of commercial. I started 100% as a residential loan officer back in the day, and this was quite some time ago. I guess I'm giving away my age a little bit here to say I was in the business in the late 80s and early 90s, and ended up growing a pretty good sized residential mortgage banking company. We had our own warehouse lines. We had our own underwriting and funding capacity. We sold loans in bulk pools and grew that company to do business in 17 states, and then eventually sold that to a large bank, bought us out to put us into their securitization so that they could round out their geographic balance and securitizations, and that was a good sale for me. Was able to exit the business and get a pretty good 7-figure payday, but then was required to stay on with that company for a few years. And I signed a non-compete with that company. Couldn't go back into the residential business after I exited. But anyway, long and the short is that I'm really a residential guy in the beginning at heart and had to make the transition. And I think my message to you is that it's not impossible to do. Matter of fact, it's very practical to do. And I think that the most successful loan officer of the future is going to be equally comfortable doing commercial as they are with residential. I think that there's a lot of crossover. You can do business with a lot of the same clients. As a matter of fact, every single day, we get numerous calls from residential mortgage loan officers that have commercial clients that either they've stumbled into or the clients have stumbled into them, but one way or the other, it's a lot of times the same clientele that they're doing residential with. And so the two are very, very complementary, but you know, you can make the transition from residential to doing both residential and commercial, or even to purely commercial, and especially if you're able to find you know, some good help in that regard. So let's talk about the reasons why I believe every residential mortgage loan officer should also be in the commercial mortgage business. And the first point I'd like to make is that it really is super, super efficient to do this. If you think about it, you are using all of the same resources. You've already got a client base. You've already got an office. You've already got a computer, phone, etc. You've already got sources of referrals that are sending you business and or whatever marketing you're doing. And if you are a company owner, you already have employees. If you're a team leader, you already have an origination team. And almost all these resources, including your same skill set, your capability of communicating well with borrowers and with lenders, and your understanding of residential mortgage guidelines, some of which do enter into the commercial underwriting side of things. You've got all these elements that are already in place. And to be able to go into the commercial business doesn't take any additional investment of equipment, of time, really. You're going to find that you will run into commercial deals just in the normal course of doing residential. In fact, I promise you already do, but you may not be noticing them because of the fact that you're not looking for them. We'll talk about that in just a little bit. But it's really, really efficient for you. There's nothing more natural or efficient as far as a marriage of two businesses than doing both residential and commercial deals. And as a matter of fact, a lot of the people that get into commercial end up getting a lot more residential volume because of the relationships that helps to generate. So it's a great opportunity for you to add an additional income stream very efficiently without any other major investment. Okay, the reasons to do this business are really compelling. Number one, you can add substantial extra revenue at little additional cost. We just talked about the fact this is very efficient for you. And when it comes to the revenue side, I just met with a lady that I'm helping put together a loan this morning for one of her clients. She's a residential loan officer. She actually runs an office for one of the large companies, but she's been doing commercial with me for the last couple of years. And she has a client she's helping with a project. Her income on that deal is going to be about $70,000, $75,000. So we're not talking about nickels and dimes here. Now, I don't want to mislead you to think that the average commercial transaction is worth that much money. That's not an average deal. The average is smaller, albeit still it's much larger than the typical residential deal. But having said that, deals of this size are not really all that unusual either. She's only dealing with a $3.5 million loan amount. It's a specialized situation and product. Because of that, she's able to generate yield spread on the deal, and she'll make $70,000, $75,000 on this transaction. And she won't spend as much time on this as she probably would spend on the average residential transaction that she does, simply because you don't have all of the disclosures and all of the regulations to deal with. So you can add substantial additional revenue at very little, if any, additional costs. That's reason one. Reason two would be to diversify your income base. Two types of diversification we're talking about here. First is to have a different kind of income. Not having all of your income come from just doing residential loans gives you an advantage when the economy shifts or the real estate market changes or interest rates go up or down. And there's so many different types of commercial transaction that you can always find deals to do in the commercial arena. It's just a matter of identifying what the economy is providing as far as opportunities at that given time. So there's a huge variety within the commercial realm, and we'll maybe talk about that a little bit later. And you'll see it in the examples of the deals I'm going to show you later on in this webinar. But the second kind of diversification is geographic diversification, because there are no regulations and no licensing in most of the states in the United States. You can easily cross borders and do business in a lot of places, so you're not reliant on any one local real estate market or one local economy. So in a couple of ways, this really helps you to diversify your income base. The third thing is to hedge against the changes that happen in our industry. The economy itself, of course, we just talked about that a little bit, interest rates, but also the residential mortgage market in general and regulations. As you know, there's been a lot of adjustments in the regulations over the last handful of years. Maybe that's going to slow down. Maybe that's over for now. I kind of hope so. But as things shift around, as things change, it's nice to have something steady and reliable that's not regulated, that's not based on the local economy only, that isn't really subject to the changes in interest rates. And the reason I say that is because one thing most people that aren't in the commercial business, one thing that most people don't know is that the vast majority of commercial mortgages are written with maturity dates, i.e. balloon payments. And so it doesn't matter what the interest rates are. When that balloon comes due, that loan has to be refinanced, period. And so when refinancing activity dies in the residential market, it doesn't die in the commercial market. And there's always people who are growing businesses, who are expanding, who are investing, even when rates are at double digits and even when the economy is slow. Matter of fact, a lot of the best real estate investors make their big moves, their big investments, their big expansions when there's negative economic conditions, because they get the best deals, and of course they still need and want financing. So it's a great hedge. Okay, number 4 reason to win and keep client and market share. If you have a dentist as a client, let's just say, in your residential business, he comes to you and he says, hey, I need to get a loan. I'm going to buy an office or an additional office for my dental practice. If you say, well, I don't do that, and you send him off to his bank, the bank's going to be more than happy to oblige for that loan. But the other thing is, that dentist just got on the bank's radar. You don't think they're going to be looking at helping him with his next residential loan, or refinancing his current deal, or helping him buy that residential rental property or whatever? Of course they are. And so the more you can do for your clients, the greater client share you retain, and the more loyalty you're going to get out of those clients. And so you can win client share and market share also, because you have a wider variety of participants in the market that you can serve if you're doing both commercial and residential. And again, it's a symbiotic relationship. When you do commercial loans for clients, they become prospects for you for your residential business, as well as the reverse. Okay, reason number 5 is to beat competitors by offering options and avenues that they don't. It's just the fact that 95% of residential LOs do not do commercial. If you do, you can set yourself apart, and you have more expertise. You have a stronger persona in the marketplace. and you have more options and offerings than they do. You're also probably going to be in a financially stronger position so that you can survive when they're having a struggle. So you're able to do better than your competitors by having more options and avenues. Number 6 reason to get into this business is to help attract top talent. Now, I'm talking specifically to the leaders of origination teams and mortgage company owners at this point, although you may be a future one of these if you're not one now. But one thing that can definitely set you apart is to be able to offer commercial when other companies don't do that. If you have that capability, if it's a strongly developed capability and expertise, you do have something to bring to the table that your competitors don't. And as a matter of fact, the lady I was talking about earlier that has that $75,000 deal we're putting together right now, she is an office manager. She does attract a lot of folks because she has developed a reputation over the last few years of us working together of being able to get commercial loans done. And she attracts the interest of a lot of folks that also want to diversify and that respect that additional level of expertise that she brings to the table, that additional market channel and opportunity that she offers them. So it can help you attract talent. It's a great tool in your bag. Number 7 reason is to add to your own professional skill set and value. You know, in this industry, you're worth what's between your ears. The knowledge, the professionalism, the skills that you have. Of course, you've got to put it into action, get out there in the marketplace and make things happen. But you become a more valuable person. Your perspective increases and improves by being able to understand both the commercial and residential side. I think you'll find that you become actually more skilled and more professional on both ends just because of that additional professional knowledge and skill. Okay, now some of the advantages. We talked about the reasons why you should be in the commercial business. Let's talk about some of the advantages of the commercial business over the residential business. Number 1, referral fees are allowable. There isn't any regulation in almost all states. There are a few exceptions. I'm not an attorney. This is a disclaimer. I'm not giving legal advice. It's up to you to check things out in your own locality. I'm happy to have a conversation with you about what I know, but I'm not dispensing legal advice. However, I will say that in most places there is no regulation, and you can pay referral fees to whoever you want for whatever you want. You can give a fee to your great-grandmother because she gave you a name and she may not have touched the file or had anything to do with it, but she knew somebody. You know, it doesn't matter. There isn't anything prohibiting referral fees, and they can be of whatever size you can negotiate. And you might be the giver of those, or you might be the receiver of those, but it's a free market. Another advantage is there's typically no disclosure of premiums or yield spread to borrowers. And let me add to that, because obviously many of you price deals in a way that you're getting some yield spread, but this is flexible yield spread. You can change from deal to deal, and also the size of it can be quite large. We have institutions that are paying as much as 6 to 8 points on transactions that actually will match the rates and terms that the borrowers can get at a local community bank. I don't know about you, but if you can place $1 million deal and make 6 points on it, that's a pretty nice day at the office. And that's just not possible in the residential arena today. I guess maybe it is when it comes to reverse mortgages, but this is something akin to that. And we're talking about large transaction sizes. Let me add too that there's other parts to this industry besides just commercial mortgages. So you've got the commercial equipment financing side of things, which I'd be happy to talk with you about if you have an interest. But it's not uncommon for people to get yield spread of 10, 12, even 15 points. In fact, there's some funders out there that are paying spreads up to 18 points on those transactions. We're talking about the smaller ones here, up to a couple $100,000 on equipment financing, but these deals close literally within days. You can get approvals within a couple of hours to maybe a day or two, and you can have docs out and be closing them a day or two after that. You don't have any appraisals, you don't have any title work, you don't have any other due diligence stuff as far as the collateral goes, other than just collecting an invoice from the seller of the equipment and providing that to the funding source. And so there's some great yield spreads and great earning opportunities with commercial that just don't exist in the residential market. Loan sizes tend to be larger, of course. I mean, the average commercial property is more expensive than the average residential property. and you'll find that you're going to be typically doing deals that are larger, and so consequently you make more money. There's fewer borders on where you do business. We alluded to this earlier. Most states do not have any licensing or regulation in any regard whatsoever as far as commercial loan brokerage goes. And there's varying categories of commercial loan brokerage. You've got commercial mortgages. As I mentioned before, you've got equipment financing, equipment leasing transactions. You've also got things in other categories as well. And the regulation varies from type to type, but for the most part, you're pretty freely able to do a variety of commercial transactions in most states without any kind of licensing regulation. So consequently, you can do business anywhere. And as a matter of fact, I will tell you that over the years, I personally have done far, far more of my business outside of the state that I reside in than where I locally do reside. And so you can attract business from all over the place more easily. People don't expect to meet with you face to face. The commercial marketplace is sophisticated enough, and the norms and customary procedures are well established enough that it's very, very easy for you to do business in a wide geographic area. And the last point I'll make about this is that it's a fun business. There's a lot of variety. No two deals are alike. There's a huge amount of difference between underwriting a hotel. They've got their own types of underwriting metrics in that industry compared to, say, underwriting an apartment building or underwriting a loan for a mechanic shop that the mechanic is going to occupy with his own auto repair business. And those are just a couple of examples, but the variety is huge. That can be challenging sometimes, but it also makes it a lot of fun and an adventure, and it's never dull. And I alluded to this earlier, besides commercial mortgage loans, there's also a variety of other commercial transaction types that you can be involved in. Equipment financing, factoring, there's what they call asset-based lending. There are others as well, and we can talk about that when we have an opportunity, hopefully, to speak at some point. But there's a huge amount of opportunity. The field is very, very wide. When the economy is such that one part isn't doing well, other parts are doing well, there's always something flourishing and doing well in the commercial marketplace. I thought that what might be most valuable to most of the people listening today is to go through a number of different actual commercial deal scenarios. These are all deals that we've either recently closed or are approved and are ready to close. So this will give you an idea what kinds of transactions are possible and see the variety that's there. Okay. This is the Westerner is a Western bar in Salt Lake City, and this was an interesting transaction. It was turned down by a whole bunch of other banks and lenders before it came to me. And one of the reasons that banks turn deals down, believe it or not, is a lot of them have what they call a morality clause, and this bar happens to have a bikini bull ride each night that they're open at midnight, and that offended the sensibilities of some of the bankers that looked at it, and I ended up having this deal referred to me, and you know, hey, the deal cash flows very well. It was an interesting transaction in a lot of ways. Actually had a pretty weak history initially. A son inherited this business from his father. He took over. It was operating in the red. They were behind and were having to pay out, you know, for various types of taxes and so forth that had accumulated that were delinquent. But the son was a good operator, very, very savvy. He was able to take the thing over and turn it around, and we were just at the far enough into the turnaround to see that that turnaround was working, that revenues had risen, that the property could support the debt. We did a $1.86 million loan on this thing. It went through the SBA 7A program. This is just an owner-operated Western bar, and the broker got paid very, very well for bringing me this deal. Very, very well. Check was in the neighborhood of $28,000. So it gives you an idea what can happen with just a very kind of an odd type of a property. Okay. All right. This one, This was a pretty interesting transaction, just in that the insurance agency that occupied this little old bank building, it was a former bank building, they had a lease option on the property, and they had been paying rent for the last several years and were getting a rent credit for their down payment. So when they came to us to purchase, able to see those rent credits. Now, I know from what I'm told that it's been some years since I've been involved in residential lending, but if I understand that if somebody is paying rent on a lease option, you can only allow a credit of the rent if it's in excess of the fair market rent. Now, in this case, these guys were getting a rent level on this property that they were occupying here at less than fair market value in total, and yet they had a rent credit contractually. Well, with commercial, you don't really have that limitation. We were able to apply 100% of that rent credit. They did not have to come in with any money as a down payment to purchase the property. Their new payment after the purchase was lower than the payments that they were making in rent. So it was a win-win deal for everybody, just an owner-occupied insurance agency situation. Again, the broker got paid very, very well on this deal. This is a very garden variety deal. You run into these all over the place. Matter of fact, one of my favorite questions to ask, and I would recommend that you ask anytime you have a self-employed borrower or a business owner as a borrower on your residential side, is just simply say, do you own or rent your business premises? And just asking that question can turn into a whole bunch of deals. If they do happen to own, it could be a refinance situation. If they're renting, then you know the drill, because you do the same thing when you meet people who are renters who ought to be an owner in terms of residential lending. So you can convert a renter to an owner just by asking a simple question. So anyway, okay. So wanted you to see that there's deals of all sizes and types here. We're going to try to show you a variety. This isn't anywhere near, of course, all the deals, but I wanted to give a variety of different transactions so you can see what's happening. This was an owner-occupied accounting office. This is the quintessential left brain, anal accountant type personality who was crunching every number. He'd been shopping his refi at every bank in town. We were able to win the transaction over by showing him advantages in terms of rates and terms, and we did some number crunching with him. So he ended up refinancing this thing. This is just a conventional first mortgage refinance. He only needed $390,000, even though the building was worth significantly more, but he was just wanting to refinance exactly what he owed. Matter of fact, he even insisted on paying his closing costs out of pocket so that the note would not increase. He was more focused on getting out of debt as soon as possible and lowering his costs in the process of doing so. So we showed him how a 5-year transaction with a soft prepay would give him the lowest rate, and because of the excess earnings that his business had, he could pay down that loan up to 20% of the original principal balance per year without any kind of a penalty, and that the 5-year rate would be the most advantageous. And he bought it. He went with us, and we completed this refi a couple months ago. But just a typical owner-occupied office building situation there. Okay, now let me show you something else that you may not realize can be financed under commercial lending parameters. This is a kind of an ugly little single-family residence, you know, we actually can do single families in several scenarios for commercial lending. One of them is if it's a rental property, and in most states we do have regulatory approval to be able to finance a single-family rental property as a commercial loan. And the only reason that somebody would go with us on something like that is because we have a stated income program for that. So this was a stated income deal. They didn't have the ability to verify income, but they wanted to do a refi on this rental property, get cash out. We were able to put that together, just collect a 1003, a lease agreement. You get a conditional approval in about 48 hours, and then collect a few more things, get an appraisal, and it's a fairly simple but not necessarily quick process. But just wanted you to see that you can even do single family. Now, by the way, just as an aside, the other scenario in which we can do single family or 1 to 4 unit properties under a commercial program is if we're doing portfolios of those kinds of properties. So as long as we have a minimum of 5 doors and $500,000, we can do a bunch of single families as a portfolio. They don't have to be near each other. They can be in different states. They can be in different towns. So we can take a handful or a dozen or 100 or 500 single families, duplexes, triplexes, fourplexes, a mix of all the above, and we can finance them as a portfolio. And as a matter of fact, that's a really common loan scenario these days. There's been a lot of people accumulating these kinds of properties, and then they can't finance any more purchases on conventional loans because, as you well know, because you're the ones referring me these deals, they run into a limit as to how many properties they can finance on a conventional loan. So what they do is they take all those, they put them into a portfolio, and they clear out that bucket, so to speak, so now they can go out and finance more conventional mortgages to acquire more properties. So we put them into these portfolios, and we're able to do this even on a non-recourse basis, by the way, meaning that there's no personal guarantee required on the loan, so that even IRAs and pension funds and so forth can own portfolios of these properties. I just wanted to mention that because I thought that might be kind of interesting. Okay.
May I interrupt? Looks like we're having some sound problems. Everyone, we're going to try and see if we can just reset the microphone. If you can hold on 1 second, please.
The fun of technical difficulties. We'll be right back with you. Okay, I hope we're back. I hope the sound's working okay. If you wouldn't mind, if we are having an issue, just put something in on the question panel and we'll be able to see that. But we had a couple of folks let us know that we had a sound issue, so apologize for the brief gap there. Okay, we're going to skip past this next slide because it's another single family. It's a purchase situation in this case. But just to know that you can do single families, duplexes, triplexes, fourplexes on a commercial loan program if they're non-owner occupied, and the reason to do that is for the stated income feature. So, okay, this is just a corporate office type situation, an office condo. What we had here is a client that came that was operating an IT business. Very, very profitable business. They owned their building. They needed to expand. There was another office condo right next door to the one that they were operating in. They decided to, initially they thought they were going to move into it. Then they decided they wanted to just keep the one they were in and buy the additional one. We initially got them approved on an SBA 504 loan at 90% LTV to be able to do that. And for whatever reasons at the last minute, the borrowers decided that they didn't want to go SBA, and they said that they'd had some experiences with SBA before. They weren't really keen on SBA for whatever reasons, and frankly, that's really exceptional because most clients love the SBA product when they have it. But anyway, they just changed their mind. We did a very quick reversal at the end of the deal. We ended up doing a refinance on their existing office condo. We used the cash they pulled out of that as the down payment, did the financing for the purchase of the condo next door. Instead of going 90% LTV on an SBA, we did conventional at 75 LTV. the rates and terms were absolutely fantastic. These people loved us, and again, we got this from a broker who got paid well, and we've since received referrals from this same client of other clients, and just a successful transaction, just an owner-occupied expansion situation. Okay. All right. So our next transaction, this is a multifamily apartment building, and this was initially given to me from a banker, a referral from another lender, and there's a lot of reasons, and we're going to get into this a little bit later, why lenders will refer a perfectly good deal to you. So one thing I want to bust is the myth that bankers and other lenders will only refer you bad quality deals. Absolutely untrue. In fact, my best quality deals come from other lenders. They turn deals down for a variety of reasons that are very, very good that just don't fit their box. We're going to go into that in more detail in a minute. I think those reasons will be very valuable to you because they can help you go get business from these folks. But this is a $4 million cash out refinance. These borrowers have owned this property for about 10 years. Interesting thing about this deal is that the partner that was referred to me on this deal owns the property 50-50 with another very well-heeled partner who owns a number of other properties. And partway through working on this transaction, that second partner actually brought me another deal, which I think you're going to see here in a few minutes. And since that time has brought me 3 more transactions. And this is just an example of how this business can work when you're out there and you're doing a good job and you're providing good solid rates and terms and you know the process, so there's not a lot of wrinkles. You get it done without, problems and issues. You get a lot of referral business, a lot of repeat business. For that one partner, the one that came to me second as a result of this referral, I've ended up doing, an additional $8 million worth of transactions just in the last few months. And as you can imagine, there's a lot of value there. So you can really generate some serious revenue in this business in a very short period of time. Okay, next deal, wanted to let you see, and this is just a good example of the range of quality of properties, because obviously the multifamily loan was a high quality building. You look at this thing, this is obviously not a high quality building. It's a metal building. It's old. The interior was in serious disrepair, but this was an SBA 504 owner-occupied situation. A good real estate broker, source of mine, referred me this client. It was his buyer, and able to get him approved on a 90% LTV to purchase this. These guys have an interesting business. They actually buy and then resell used shoes. And when I say buy, they get a lot of them via donations. But they do purchase them from places like Goodwill, and they have schools collecting shoes for drives and so forth. And anyway, it's an interesting business model. They've been doing this for a number of years, and who would have thought you could generate millions of dollars of revenue buying and selling old shoes? But that's exactly what they do. You run into a lot of interesting things in this business. In this case, by the way, there were 2 partners. One of them had really excellent credit. The other one had really, really poor credit. So 50% of the sponsorship of this loan had poor credit. Matter of fact, a no score on 2 of the bureaus. All there was 1 current account and a whole bunch of collections. We were still able to get this thing approved. And not every lender will do that, of course. Now, the one thing about SBA is not SBA. And the way you structure a deal can have a lot to do with whether it gets done or not. But because the sponsorship was strong on one end, we were able to get an underwriter to look at this as, well, hey, if I had just this guy, I'd do the loan. If I have another guarantor, how does it hurt me? We were able to get the loan done even with some weak sponsorship there. Okay? So, okay, here's the next one. It's a single-tenant office building, and you'll see this coming up in a moment here. This is a non-owner occupied single tenant deal, so it's not an owner occupied situation. Again, a pretty interesting transaction in that it's a 1031 exchange situation. So for those of you not familiar, the buyer / borrower had other properties that he sold into a 1031 exchange and had to reinvest the proceeds within a certain set period of time in order to avoid capital gains taxes. So he found this property, single-tenant property, did not currently have a tenant in it, but was up for lease. The agent that referred this transaction to me was helping him to lease the property. We thought we'd get it leased prior to him having to close on his purchase loan. That, in fact, did not happen. So we had to close a bridge loan to accommodate this borrower so he could meet his 1031 exchange deadline and not lose out on those tax benefits. And now the great thing about that is, of course, we make money on that deal, and now as soon as he gets a permanent tenant in the property, we're going to go ahead and close the permanent loan we'd already committed on this deal. So this is an example of how one deal can turn into two deals, and also how you have to be flexible because you're going down the road on these transactions, and there's just a lot of ways that things can twist and turn on you, but you have to be scrappy and figure out how to get it done to accommodate your clients. But good quality office building, super project, and a really strong borrower, $925,000 loan amount. And just as an FYI, by the way, I just want to mention that we actually, in some states, we do pay real estate brokers for bringing us transactions. They are able to verify for their own benefit that there isn't any reg against doing that in their particular locality, that they can actually be paid on a real estate transaction and a loan transaction at the same time. Other commercial brokers don't want that. They simply want us to help them close their deals so they can get paid. But I just thought it might be interesting for you to know that there are some real estate brokers in the commercial arena that do get paid, and it is perfectly legal in some cases, although, again, quick disclaimer, not a lawyer here, okay? All right. Our next transaction is a student housing project in a tertiary market. And what's interesting about a deal like this is it's in a small market, small population, a little college there. So you know, in case you're not familiar, there are a lot of multifamily lenders that will not make a loan in a market with a population less than 250,000. There's some other lenders that won't go below 150,000 or 100,000. It's actually very unusual to be able to get a loan done competitively with some type of a program other than a local bank in a little teeny tertiary market, and it's even more unusual to do that on a student property. With multifamily, there's a lot of different property categories. You've got student projects, you've got subsidized projects where they have Section 8 or other subsidized rents. You've got furnished versus unfurnished units. You've got studio or efficiency units versus regular market units. There's a whole bunch of different factors that would make a project qualify under one program and not another, or not qualify. And it's a really interesting marketplace. But anyway, able to get this deal done. Matter of fact, I'm celebrating because I just funded this one yesterday, and that was a great deal. That was referred by a banker. So this is the one I mentioned. This is one of the ones that the partner of that original multifamily project I showed you that we did a refi on. This is that partner purchasing this project who engaged me partway through that refinance, said, hey, can you help me on this one too? So this is how deals lead to deals. Things can snowball a little bit. Okay, now to the extreme here, I wanted to show you this next deal. It's a little office trailer and a little old, pretty dilapidated looking warehouse. And this is only a $100,000 loan, and if you look at the property, I think you'll be able to appreciate why, because the property's not worth much more than that. But that's one of those modular offices there. These guys are a little cement manufacturing company or something like that. And I think I'm crossing deals here. I apologize. But anyway, this was a non-owner OC. The owner just owns this as a rental property. This was a cash-out refi. The property was free and clear at the time. We did this on a stated income basis. A broker brought us this deal. Broker was paid. But I just wanted you to see some of the extremes. When we talk about commercial lending, it doesn't always mean the big, beautiful trophy properties. I mean, right now, I don't have it up here because we don't have it approved yet, but I'm working on a $15.5 million refinance of a beautiful Class A medical office. And, we're competing against the likes of Wells and other big banks, and we're beating them by 40 basis points because we're able to get money from life companies and so forth that the banks just can't compete with those cost of funds. So you get everything from that extreme of high quality to something like this. So there's never a dull moment in this business, and you know, you can do or not do the little deals, but I recommend doing them because deals lead to deals. So this is another example of that type of thing coming up next. This next property, this is actually, there's a single family home and an old shop on this commercial lot. It's commercially zoned. It's like an 1.5 acre lot. This was purchased by a landscaping company that wanted to occupy this to operate their business, use the shop and then use the house as offices and for storage and supplies and so forth. They bought this thing with the intention also, we included about $90,000 of renovation rehab money because they needed to fix some things and add some fencing and do some paving and so forth. So, you know, a deal like this is based almost completely on just the cash flow and credit of the owner occupant. You can do almost any kind of property when it comes to this type of SBA financing, even an old commercially zoned house like this with an old dilapidated shop. So you got that. You've got about anything. Special purpose properties, hotels, gas stations, et cetera, et cetera. So, okay. Now we've got another one we're going to show you here. This is a deal that has a salon, beauty salon on the main floor and an apartment in the basement. And it just so happens that the owner of the property occupies the residential portion and leases out that salon space. Well, about 6 banks turned this down. He was everywhere, and they couldn't do the deal because it was owner occupied. And they said, well, that kind of crosses the line between residential and commercial. You're occupying this as a resident, and yet obviously this doesn't fit residential programs. This guy was kind of caught between a rock and a hard place. Because of that, we were able to get it done on a stated income program, and this deal is currently approved and getting ready to close. So just another example. This again was referred by a broker. As you probably noticed, a lot of our deals are. So again, a good variety of different transactions. And the reason this went stated isn't really because he needed to go stated. It's because it was the only program where we could do this occupancy situation, so we took it stated anyway, even though this particular borrower had plenty of income and so forth. This is just a regular little old cash out refi on some apartments. And they were also doing it to lower their rate, but they needed about $100,000 cash out to do some roof repairs and so forth. And good, strong borrowers, turned out to only be about a 50% LTV. We got the deal, frankly, just because our rates and terms were superior to everybody else they were shopping. That's really the bottom line. It was they were currently at about 7% before they refinanced, and they're at 4.2 now on a 7-year fix with a 30-year AM. They're very, very happy people. And that was actually a direct borrower that was referred to us. Actually, you probably noticed most of these deals that we've shown you are either from a broker or a banker. This is another broker deal, just a small little sixplex. They had to close really, really quick. They had when the deal came to us, it was a very, very short fuse on their REPC, and the borrowers happened to have enough cash to go ahead and just pay cash for the property. And about a week after they paid cash, we did a refi, got them 75% LTV, back cash in their hands, so that they were, you know, able to have some leverage on the deal. So delayed purchase transaction, you know, treated like a purchase even though it was a refinance. Good little transaction there. And this is an owner-occupied office warehouse. This is an electrical contractor, very profitable business. They'd been renting. When somebody's renting and they want to move into their own premises, in this type of a business, it doesn't really matter where they move because their customers don't come to them, so to speak. If you're doing the same thing and it's a restaurant or a retail store and somebody's moving, you know, 10 miles down the street, you know, or a gym and they're moving 10, 15 miles down, you're going to have some troubles with that because, of course, the first question on our minds and the underwriter's mind is, well, are the people going to move with them? Are their customers going to move with them? But in a case like this, it really didn't matter at all. They could put the business wherever they wanted it. It qualifies based on the business's revenue, and they had great revenue history. This is a conventional purchase. They put a lot down, and just a simple deal from a broker again. All right. This is just a small SFR purchase. I'm just going to skip past this because we're starting to run short on time. I want to get to some how-tos and some details for you right now. The first thing that you got to decide if you're going to get involved in this business is whether you want to be a specialist or a generalist. And there really are advantages and disadvantages to both. I've actually done both in my career. At one point, I owned a company called National Apartment Finance. So you can't get much more specialized than that. All we did was apartment buildings, and I did hundreds of those during those years, and we did them all over the country. And that was a great business, but I was constantly turning down transactions of other types because the very same borrowers that were coming to us with those apartment buildings owned other properties, were requesting other things, and we started doing other things. I tell you this, one of the things I've realized is, especially when you're starting out, it really does pay to be a generalist as long as, and this is a big as long as, you have somebody to go to help you to size and price and qualify the deals, because it can be a little overwhelming at first if you're trying to do a whole bunch of different types of loans in the beginning, because these are all very different from each other. You know, the Fannie Mae multifamily program or Freddie Mac multifamily program, those are way, way different in concept and design and underwriting than an SBA 7A versus an SBA 504, you know, versus just conventional term lending, versus the non-recourse types of programs, you know, construction versus perm, you know, very, very different. The different property types, you know, special use properties, general use properties, they all have their own lexicon of vocabulary and issues. You know, hotels have their own particular issues. You know, you're dealing with things like RevPAR and occupancy rates, daily room averages, and so forth. I mean, they're just metrics that come into play on certain property types that you don't get on other property types. And different underwriters specialize in different ones of these. I think what I have learned is that when you cast a broad net, you get a lot of deals. You just better be good at sorting out and getting them done, or you're going to choke on them. If you know, but as a broker starting out, you're going to find a lot more success more quickly that way. Okay, so now's where the rubber meets the road. When you do get a commercial lead, how do you do it? Well, I've got 2 easy steps you can follow to do any kind of commercial loan you want to do. Obviously, there's a lot of different property types, a lot of different scenarios out there, and even non-real estate deals. And so this could be very complicated, but what we've done is we've created 2 really easy steps. And here's what they are. So first of all, you want to just get a little bit of information together about the deal. Just have a friendly conversation with the borrower and find out a little bit about them and find out what they want to do. Just talk to them. Make it a conversational type thing, not like you're grilling them. But in the course of that conversation, find out what the loan amount is that they're needing. Find out the purpose of the loan. How are they going to be using the money? Are they purchasing a building? Are they purchasing a building plus they want $300,000 for some improvements or construction on the building to make it ready for them to move in? Are they refinancing to get a lower rate? Are they wanting to pull cash out so that they can invest that in something else, another piece of property, or into a business? Just get the details and get a breakdown of how they're planning on using the money. Is this a partner buyout? You know, one partner buying out, you know, the other so that they own 100% of the business? You know, whatever it is, just find out what it is they're going to be doing. Find out the loan to value, and this applies whether or not this is real estate, equipment, a business acquisition loan. For example, if they're buying a business and the business is worth $1 million and they want to borrow $750,000, of course that's a 75% loan to value. So all of these things have a loan to value component. The one area in which you may not even need to worry about that particularly is in equipment financing, where it's very, very common to finance 100% of the acquisition of new equipment. And then find out what kind of property will be used as collateral. Is it an apartment building? Is it an assisted living facility? I have to laugh. I have to tell you how many times I've had conversations with a broker that calls and says, I've got a guy, he wants to buy a commercial property. What kind of loan to value can we go? And I'll say, well, what kind of property? And they never thought to ask. And it's a kind chuckle, because I can't blame them. This is not the field that they're used to dealing in. And when you're in residential lending, a house is a house. Maybe if it's a single family home, doesn't matter whether it's brick or siding, or whether it's got, you know, a half an acre lot, or whether it's 2 stories, or, you know, all that stuff probably doesn't matter. Obviously, there's some things that don't fit, but for the most part, a property is a property. But with commercial, that's not the case. You want to find out as much as you can about the property. Is it an office warehouse? Are they going to be occupying it, or are they planning on renting it out to tenants? Is it a retail building? Is it standalone, just a standalone retail? Is it a retail strip center? Is it a car wash, for example? Just get as much detail as you can about the kind of property and about the location. And when we say location, we're talking city and state. Okay, so that's step 1. Just have a friendly conversation with your borrower and find out everything you can about the transaction that they're wanting to do. The second step is easy. Pick up the phone and give me a call, or shoot me an email at the email address you see there, joemardisich@gmail.com. And I prefer a phone call, but if you want to send me an email with what you know, then we can get on the phone and talk about it. So the great thing about this is, usually if you've done a reasonably workmanship job on the first part, within 5 minutes of us talking on the phone, most of the time, I'll be able to give you some terms that you can quote. I'll be able to generate a needs list of items for you to collect from that borrower. And you can go back with that preliminary quote and collect those items and let the borrower know that, hey, this is about what we can do, but to solidify that, we need to collect some information, and then we'll issue a solid proposal for you, or a letter of interest. So really, really simple. And if the deal is not a fit for me with the current lending organization with which I am working, then I will help you find the right lender for it. So you can't go wrong here. I've been in the industry a long time. If there's a way of getting it done, chances are that I can tell you how and with who to get it done if it's not me. And if I don't have something competitive for you, then I'll refer you someplace else, because I don't believe in wasting time on trying to bring in transactions where we're not competitive. We end up losing the deals at the end. You wasted your time, I've wasted my time. Either that, or the borrower finds out later they got a lousy deal. None of that's worth it. So I'm only interested in doing the transactions that actually we can do a very good job of serving that customer. Okay, so once we get to that point, once we collect some information from there, I'll walk you step by step through the rest of the process. We'll put a letter of interest together. You'll be able to present that to the borrower. It's pretty easy from there, but I'll walk you through. So very, very simple to do a deal. Now, if you do want some direction on how to go out and market for commercial deals, or how to get commercial deals from your current centers of influence, your current referral sources, your current client base, I'd be happy to talk to you about that. All you got to do is give me a call, shoot me an email. We'll schedule a time. We can spend a few minutes. I can consult with you on what your referral base is, what kind of situation you're in, and how you can best go about marketing and getting some business. It's really very, very simple. You'll be shocked at how quickly you can get a flow of commercial deals with just a little bit of coaching from me. So anyway, I hope you have enjoyed our webinar on the art of commercial mortgages for residential loan officers. I look forward to hearing from you, and have a great day.